All right, let's talk about one of the most emotional, most chaotic things you'll ever see in finance, the market bubble. Today, we're going to dig into some really fascinating research that suggests, maybe there's a hidden order, a kind of secret geometry behind all those wild, crazy price swings. We've all seen a chart that looks just like this, right? It goes up, and then it just goes vertical. It feels like pure, raw emotion, just greed and euphoria completely running wild. You look at it and you can't help but think, this is just random noise. There's no way to predict this. Well, what if it's not? What if you could take that entire chaotic mess of a run-up and frame it with a simple shape you learned about back in high school geometry? This is the wild idea we're going to explore today, that these massive parabolic blow-offs might actually follow a repeatable geometric structure. So let's get right into the mechanics of this thing. The whole framework is called the Parabolic Triangulation Method, or PTM for short, and it all starts by taking that messy, emotional price chart and turning it into a clean, measurable object. The very first step is to draw what the research calls the inclined triangle. Now, it's a simple right triangle, and it's defined by just 3 key points. You've got the anchor, which is where the insane part of the run-up really starts. You've got the apex, which is the absolute peak, the top. And the corner just squares it all off. And just like that wild curve suddenly has a shape we can work with. Now, what's really cool about this is how each part of that triangle tells a very specific story. The bottom leg, the horizontal one, that tells us the duration. How long did the mania last? The vertical leg tells us the magnitude. Just how high did this thing go? And then the angle, theta, that measures the intensity. How fast and how furious was that climb? It's literally translating market psychology into simple geometry. Okay, so we can measure what already happened. Big deal, right? But here's where it gets really powerful. This triangle isn't just a description of the past. The research suggests it can actually work like a blueprint for what's about to happen next. Let's see how that works. So the process itself is surprisingly simple. First, you measure the inclined triangle for the bubble that's happening right now. Second, you go back and look at other historical bubbles and you figure out the ratios between the run-up and their eventual crash. And finally, you take those historical ratios and apply them to the current triangle to project a couple of possible crash scenarios. And this is a really key finding from the source material. The crash isn't random either. It turns out, when these things pop, they tend to follow one of 2 very distinct paths on the way back down. So you've got class 1, the step bounce. This one has a sharp drop, then a deceptive little rally, a bounce, that tricks people into thinking the worst is over before the final leg down. And then you have class 2, the straight crash. This one is just relentless. A single, brutal, uninterrupted slide all the way from the top to the very bottom. And this is so important. The research is crystal clear on this. That bounce you see in a class 1 decline, it's a trap. It looks like a recovery, it feels like a recovery, and it sucks in buyers who are just about to get hammered by that final wave of selling. And get this, here's another absolutely crucial insight. When these bubbles finally pop, they don't just erase the gains from that crazy run-up. The data shows they often overshoot on the way down, meaning the final bottom ends up being even lower than the price where the whole thing started. Okay, I know this all sounds incredibly powerful, maybe even a little too good to be true. And you'd be right, because the entire system hinges on one single, very tricky variable. And yeah, it's pretty much the model's Achilles heel. And that big, tricky question is this: where exactly do you start measuring? That anchor point we talked about, how you define the beginning of the run? Well, it changes everything. And this slide illustrates the problem perfectly. As the source material points out, choosing the anchor point is a definitional choice. It's not a fact of nature. If you just shift that starting point a little bit, suddenly the size, the duration, the angle of your triangle, it all changes. And of course, that means every single projection you make from it also changes dramatically. So the most important thing here is being intellectually honest with yourself. There is a very real risk of falling into a circular logic trap. You can't just pick an anchor point, see that its projections look about right, and then use that as proof that your anchor was correct in the first place. That's just a self-fulfilling prophecy. So how do we get around this? How do we build any confidence if that anchor point is so sensitive? Well, the answer isn't to trust this one method blindly. The key is to see if multiple independent methods all start pointing to the same general area. This is exactly what analysts call finding convergence. You're basically looking for a cluster of evidence. Do the PTM projections line up with classic tools, like Fibonacci retracements? Do they line up with major market peaks from the past that might act as a support level? Do they jive with what some machine learning models are predicting? But, and this is a really sharp point from the source, you gotta be careful. Some of these methods aren't nearly as independent as they seem. For example, both PTM and Fibonacci levels are often calculated using the exact same anchor to peak measurement. So of course they're going to be similar. Real confidence, true validation, comes when the PTM projections align with something totally separate, like a major market peak from 5 or 10 years ago that has zero mathematical connection to the triangle you just drew. So what's the big takeaway from all this? Look, the parabolic triangulation method isn't a crystal ball. It's not going to eliminate risk or make you a perfect market timer. But what it does do is offer this compelling, fascinating framework for seeing structure where most of us only see chaos. And it leaves us with this incredible question. Could the emotional madness of market bubbles actually have a hidden geometric language that we're only now just learning how to read?